I hope everybody is keeping safe during this whole COVID-19 situation. It's something that's definitely unprecedented, and I hope you're all making it a priority to keep your family safe and yourself safe. This is definitely going to be something we'll all be telling our grandchildren about, I think. so, so it's also giving us an opportunity to learn how to use Zoom. so, so there's some upside there as well, I guess. Um, Also, I can't believe Ramadan is right around the corner. Wow, this came pretty quick. And earlier in one of our meetings, someone was telling us, make sure you don't go to the mosque. Ramadan is coming up. And that's a statement I never thought I'd ever in my life hear. So I guess we're definitely in some wild times right now. All right, I think we've had more people joining. We've got quite a few people registered, and I think this is also being broadcast on Facebook as well. So I'm gonna go ahead and get started. I hope everyone can see me okay and see the screen. We are talking about ShariaPortfolio Canada. Our newest company that we just launched in Canada. We're a Canadian company that is offering Sharia compliant and halal investing throughout Canada. So I'm going to talk a little bit about that and give you a little bit of an introduction. And I'm going to try to keep this as interesting as possible, given that we're talking about financial services. We'll start off with a quick disclaimer. I am actually broadcasting from the US. I'm a US-based financial advisor. And quick introduction. My name is Noshad Virji. I'm the CEO of ShariaPortfolio Canada, and I'm also the founder of ShariaPortfolio in the US. Our company was founded in 2003. We have over 2 decades of experience in managing Sharia compliant portfolios. And, you know, we've had a lot of media coverage, and in that time, we've been on a lot of different TV networks. There have been a lot of articles about us. Google us sometime, you'll see all the great stuff about us online. Last year, our affiliate, SP Funds in the US, launched 2 publicly traded ETFs, which we're also very excited about. So the agenda for today's discussion is the following. We're going to start off with a quick intro to ShariaPortfolio Canada and what we do. We'll also talk about the stock market. We get a lot of questions about the markets and how they work, and so we'll cover that as well. Then we're going to talk about value investing, which is a investing philosophy. Then we'll talk about Sharia compliance. How is all of this Sharia compliant and halal? What do the scholars have to say about all of this? Then we'll talk about how to get started, and then we'll open it up to questions and answers at the end of the session. We have our portfolio manager, Nadeem Mian, who's joining us in the call as well, and he's going to be speaking during the Q&A session. So let's start off with what is ShariaPortfolio. I'll start off with our mission. ShariaPortfolio Canada offers professionally managed investment solutions that help Muslims achieve their life goals while honoring their personal values. Essentially, it means we don't have to compromise when it comes to investing. We can continue to adhere to our personal values while still investing in some great companies that are available in the market. Our company, ShariaPortfolio Canada, is licensed by the Ontario Securities Commission as a portfolio manager. Our US company, which was founded in 2003, is licensed by the US Securities and Exchange Commission. We'll be working with clients across Canada and also around the world. We are fully dedicated to Sharia compliant portfolio management. So we don't do anything else. This is our core competence and our total focus. We're very excited about partnering with Fidelity, which is a top tier custodian. So our clients who open accounts at ShariaPortfolio Canada are technically going to have Fidelity accounts. Our 2 service levels at ShariaPortfolio Canada are Access and Express. So our Access level service is the premier solution for comprehensive wealth management. whereas our Express service is an economical solution to halal investing. What that means is with Express, you can kind of get quickly up and running. If you need a more comprehensive solution, the access level service gives you all the bells and whistles as well. Our accounts are insured up to $1 million by the Canadian Investment Protection Fund. And we'll move on to the stock market. So this section is pretty interesting. I like to go straight into the basics because we get so many questions at ShariaPortfolio on what are stocks actually, what are bonds, what is all this stuff about, and how does it work? So I love going to this section. So some of this might be a little bit basic, but believe me, it will get a little more interesting. I'm going to start with the basics and move on from there. So what is a stock? A stock is a part ownership of a business. When you own a stock, you're a part owner of a company. So have you ever wanted to own Apple or Microsoft? Well, if you buy even one share of that company, you are an owner. So a stock is actually a simple thing. It gives you ownership of a business, a part ownership. So what are bonds? Bonds are interest-based fixed income securities. A bond is really a loan. When you buy a bond, you're technically loaning someone money, and that someone is either a company or a government, and then they're paying you a fixed rate of interest. So bonds are not Sharia compliant because they are interest-based. So we do avoid bonds in Sharia compliant investing, but it is important for people to understand what they are and why they're not Sharia compliant. So that leads me to a sukuk. This is a newer type of investment which is actually Sharia compliant. It's kind of an alternative to bonds. Some people refer to sukuks as Islamic bonds. They're actually not bonds because they're not loans. With a sukuk, you're basically investing in a fund which buys assets and leases it to people. So it's a safe way to get, or I should say a safer way to get a return that's not quite as volatile as the stock market can be. And a portfolio is nothing more than a collection of all of these types of investments. So if you have a portfolio, you probably have different stocks, possibly some sukuk funds, maybe some other mutual funds or ETFs. But a portfolio is just your collection. It's like your wallet. You have these credit cards or this cash or whatever else. So that's what a portfolio is. So I like to start off with this graph. And the reason I like to start off with this is because I hear a lot of times people are worried about stocks and investing, and isn't it possible I might lose all my money, or like, how do you explain all this volatility? Look what just happened last month. And those are all fair points. And so when people are afraid of the stock market, this graph that you're looking at right now, this is what they're talking about. This is the 1 year period in 2008 to 2009 where the markets crashed and they went down about 39%. So this is probably fresh in a lot of people's minds. This is the financial crisis that we saw back then. And yeah, we had a pretty big drop. And when you look at this, it does put a little bit of fear. So I want to put this into context. When we look longer term, that little area in the circle that you see on this graph, that's the area we were looking at earlier, that 1 year period where the market took a big drop. Now, one of the things you'll notice here is that long term, the markets actually continue to grow about 10% a year. So when you're investing in the stock market, when you're investing in businesses, you want to think long term because the long term trajectory is pretty impressive. In the short term, anything can happen. You can have a year like 2008 where the markets go down 39%. You can have a year where it goes up substantially. There's quite a few of those as well. But long term, it balances out pretty well, as you can see here. So the point of this part of the presentation is really that if you're investing, you really need to have a long-term time horizon in mind, a long-term mindset. So let me move on. What are the reasons to invest? Why should you consider this? As you can see here, some people think, I need a big house or a nice car. Some of the common considerations are retirement or education or just even tax savings. saving up for Hajj, being able to donate to charity. There's a lot of great reasons to consider investing. One of the things that a lot of people underestimate is how much you can save on taxes when you're investing. So tax efficiency is actually a very important consideration in investing. I'm going to show you a slide that's going to exemplify that. Right here, you can see that taxes actually significantly reduce returns. If you make, say, a 9.7% return in a stock, if you're paying taxes on that, you're really only left with about 6.89. So one of the things that you really want to consider is your tax situation and trying to take advantage of accounts that give you tax deferrals or tax exemptions. And if you speak to a financial advisor or a portfolio manager, they can kind of give you some advice on that and direct you towards the right type of accounts. One of the most important reasons to invest. Okay, this is the one slide. If you guys are playing games on your iPhone right now, put it down for a minute and just take a look at this, because this is probably the one slide you want to remember when it comes to why do I want to invest. You need to think about revenue streams. What I mean by that is, where do you make money from? So on the left side here, someone who's in their 20s, right out of college, got a great job somewhere, and they've got a nice paycheck coming in. Odds are 90% of people, 90% of your money at that stage is coming from your paycheck, maybe more. And this is pretty typical. If you have any other income going on, maybe it's a small amount from stocks or other types of investments. But mostly your primary income source is your job. So if we shift over to the position on the graph on the right, now we're looking at a situation where you're getting more of your income from other places like stocks or other investments. So our goal really should be, from the time we're in our early 20s getting our first job to the time we're getting closer to retirement, to make our paycheck a smaller portion of our overall income. That doesn't mean you need to make a smaller paycheck. It means your paycheck should be less of your overall income. What you're doing is creating income producing assets, multiple revenue streams. It's kind of like this. You've heard the expression, do you want to put all your eggs in one basket? No, you don't. You want to have income coming from different places. So your goal is to make your primary source of income, your paycheck or whatever that is, a smaller portion of your overall income. If you're in your 60s, 50s or 60s, and you're looking like this graph on the right, where your paycheck is only 20% of your overall income, and you're making 40% of your income from stocks and another 40% from some other source, then you're in a position where you're working because you want to, not because you have to. And that's a pretty sweet position to be in. And that's something that I think we all want to strive towards. And this is really a big reason to consider investing. You need to produce income producing assets, and these multiple revenue streams will help you later in life. So what are these other investments that we refer to? That could be real estate, that could be gold, jewelry, business startups. Your friend is starting up a business and you want to take a small stake in that. Currencies, whatever it is, there's a lot of different things you can do. So it's not just stocks. The reason obviously we focus on stocks, but stocks are a very easy thing to get into because of liquidity. That means you can get in and out very, very quickly. Some of these other investments, like investing in a startup or real estate, that's more of a long-term proposition. So it's nice to have a balance of both. So that's my piece on the stock market. Now let's talk about value investing. We'll start with a definition of value investing. And this definition is by Benjamin Graham. He is the college professor who taught Warren Buffett how to invest. And Warren Buffett, as you might know, is the world's most famous investor. And so we might want to hear what these guys have to say about this. So Graham's definition of investing is an investment operation is one which, upon thorough analysis, promises safety of principal and satisfactory return. Operations not meeting these requirements are speculative. So essentially, you want to do your homework. If you're not doing your homework and just buying and selling, you might be speculating. So we believe in value investing. There's a lot of different schools of thought on how to invest. You might have heard of technical analysis. You might have heard of quants, where the computers are choosing stocks for you. Day trading. There are different ways to invest. We at ShariaPortfolio, we really believe in value investing. And what that means is we want to engage in fundamental analysis, which basically means we want to understand the business we're buying. Because if you remember earlier, I told you when you buy a stock, you're now a part owner of a business. So you're effectively buying a business. So if someone comes over to you, or let's say I come over to you and say, hey, I'll sell you ShariaPortfolio for $10 million, you're probably not just going to write a check. If you are, contact me after this presentation and we can chat. But more likely, you're going to have a lot of questions about the company. You're going to ask, how much does the company make? What assets does the company own? How good is the company compared to its competition? Who is the competition? How good is the team? There's a lot of, probably 100 questions you would ask before you invest in any given business. So as value investors, that's how we feel about buying stocks. Because when you buy a stock, you're now part owner of that business. So we really believe you want to focus on treating every stock as if you're buying the whole business. And then if it's a good deal, then you buy. So one of the big questions we get at this point is that isn't the stock price what a company is worth? Now, in our school of thought, value investing, we actually believe that there's a disconnect between the value of a company and its stock price, which we believe is the perception of value. Just a quick case in point. Let's talk about Apple. That's one of the biggest stocks in the stock market, one of the biggest companies in the world. In 2007, you might remember, they invented the iPhone. And everyone was crazy about Apple stock all of a sudden. The stock price goes all the way up to $240 a share. So we went into this fundamental analysis and we started doing some research in the US on what is this company really worth? And we thought that 240 is pretty high. We felt that, a more fair price might be 100 or somewhere thereabouts. So we decided to wait. We had a lot of clients calling and we told them, let's wait, it's just too expensive right now. So 18 months later, that financial crisis we talked about earlier hits. And now Apple is trading at $80 a share. So we got really excited, called everybody and telling everybody that, if you wanted to buy Apple at 240, we told you to wait. Now it's 80. We need to jump on this. It's a great deal at $80 a share. Fast forward another 18 months, and now the stock is $350 a share. So my point in the story is that you have a company that's phenomenal, that's selling incredible products like the iPhone. And one year, their stock price is 240. The next year, it's $80. And then the year after that, it's 350. So if the stock market is really about value, then it's hard to believe, the stock price wouldn't fluctuate that drastically in such a short time. In this case, the price was all over the place, and it's Apple. It's a great company. There's not that much that changed in the company in that time period. They were making a great product and selling as many as they could produce. So we believe the value of the company was pretty impressive at that time. It's just the stock price that was going up and down. So then people ask, well, why does that happen? That's because the stock market is really about volume. It's about buying and selling. What determines the stock price? It's really just one thing. How many people are buying a stock and how many people are selling? That's it. If more people are buying a stock than are selling, the stock price is going to go up. If more people are selling than buying, it's going to go down. Doesn't matter how much the company is making or anything else. So The stock market, in our opinion, is there for us to take advantage of. Stock prices will just keep going up and down all the time. We're going to take a look at every stock as a business, and we're going to figure out what's the best price to buy that business. And when the stock price comes down to the levels we feel comfortable, that's when we'd want to buy. And that's essentially what value investing is all about. Now, remember I told you earlier, all those people we called that wanted to buy Apple at 240. What I didn't tell you is when I called them back to buy that stock for $80, not a single client said yes, not one. So why would somebody say buy it at 240, and then when the price comes down to 80, they'd say, no, I don't want to buy any? Basically, Warren Buffett has an answer to that. He says, be fearful when others are greedy, and be greedy when others are fearful. Now, he's not proposing we all be greedy. What he means by this is that when everybody feels like they can do nothing but make money in stocks, then we might want to be a little more cautious, be a little more fearful about what's going on. So Apple at 240, yeah, maybe we ought to be careful when the markets are going that well. And everybody thinks they're doing extremely well. Maybe we need to back up a bit and be careful. But when everybody's fearful, like in 2008 and 2009, when the markets were dropping drastically, or maybe like last month when we all of a sudden had significant amount of volatility, that might be a good time to buy. One of the things I'll share with you that I think I found very interesting in my experience is that the stock price is the stock market is the only market on earth that I know of that people want to buy only when the prices are high. Think about that. When you're ready to buy that brand new TV, you're going to wait for a deal at Best Buy. You're going to wait for Black Friday probably, or you're going to wait for a deal on that new car. But with the stock market, in my experience anyway, a lot of people wait for the markets to go up before they buy. So that's just something to think about. I think you would do well being a little greedy when others are fearful, as Warren Buffett would put it. So let's talk about Sharia compliance now. How is all of this halal and according to who? Let's go back to a definition. Halal investing refers to investments made in securities which conform to Islamic principles. When these investments adhere to the guidelines of a trustworthy Sharia advisory board, they are considered to be Sharia compliant. So this is according to IOFI. IOFI is a governing body, a Shura council of scholars based in Bahrain. The scholars are from all over the world, so it's a pretty well put together Sharia board. And they literally write the book on what is Sharia compliant, what is halal, what can we invest in without sacrificing our personal values. So when we first started, we were looking at different standards, and there's not so many different standards, but there are a few out there. And the reason we decided to go with IOFI from day one is because, first of all, it's the most strict. And our name is ShariaPortfolio, so we better be Sharia compliant. So we went with the most strict standard that's out there. Secondly, it is considered the gold standard. I think more people follow IOFI guidelines than any other as far as Sharia compliance. So we felt very comfortable in going with this. And I think we were the first one in the US, I believe, to follow these IOFI guidelines in portfolio management. So what are these guidelines? First of all, you have to avoid non-compliant income sources. So these are kind of the obvious ones. You don't want to be invested in gambling or alcohol or tobacco, businesses that have significant amount of debt. These are all things that we try to avoid. So these are kind of obvious. On the guidelines, we can only invest in stocks, sukuks, and funds. So we do avoid preferred shares and options trading. If you don't know what preferred shares or options trading is, then don't worry. You don't really need to worry about it. Just focus on stocks and Islamic funds. But the other guidelines that people are ask about, and this is probably the more complicated part, the financial ratios. What this means is we have to look at how companies are doing business. So one of the criteria, and this is the one that probably weeds out more stocks than anything else among the guidelines, is debt. If a company has debt, that debt needs to be less than 30% of their total market cap or the value of the company. These are non-Muslim companies. We don't have full control over what they're doing, but we do want to avoid debt and have little to no debt. So this metric actually weeds out a lot of companies from our investment horizon, from our investment pool. Because a lot of companies borrow money and borrow a lot of money. There are sometimes there's companies that are really good, like Amazon, that started up and borrowed tons of money, but we can't touch it because of all the debt. There's a lot of companies that end up going out of business. Think back to 2009, just because they're so overrun with debt. So this helps us more than it hurts us by avoiding debt. Another criteria is the accounts receivable of a company. That should be less than 30% of the total assets. The reason that that's important is that an accounts receivable is basically when you owe a company money. So when you owe a company like, say, General Motors, they sell cars. There's nothing haram in selling a car. But if they're lending you or lending you money and you're paying interest on that, now you're engaged in a financial transaction where that's based on interest. And if a company has more than 30% of their receivables in accounts, more than 30% of their assets in receivables, then it kind of implies they're doing a lot of financing. So we try to avoid companies, not just companies that are in debt, but companies that are putting others in debt. So that's why these first two metrics are important. One of the other common questions that we get is about this last point, and that is, well, what about companies like Delta Airlines? They're not doing anything haram necessarily when it comes to transporting you from one place to another. Why, what about the alcohol that they sell on the plane? So according to the scholars, and again, we refer back to the scholars for these kinds of things. We don't make the rules, we're following their rules. If the non-compliant activities, the non-Sharia compliant activities are less than 5% of the total income, it's acceptable to invest because that's not the business they're in. Delta is not an alcohol company, but we do need to purify our income. So in the case of Delta, I'll just continue using that as an example. Their total alcohol sales are somewhere around 1% or less, actually, of their total revenues or their total income. So if we make money from Delta, what we'll want to do is take 1% of the money we made and donate that to charity for purification. So this is one of the things we do for our clients. We let them know in their portfolios what that purification number is every year. And typically it is around 1% of your income, not 1% of your investments, but just your income. So it's not too bad. And there are various hadith to support this. But in general, in most of the Sharia compliant stocks I've seen, it generally is around 1% or less. So let's go on to getting started. How do you like the idea of investing, but how do you get started? What are the different ways to get involved? One of the easiest is to just self-manage with a brokerage account. You could open your own account at your local bank or whichever financial firm you like, Questrade or whoever you want, and open an account that lets you buy and sell stocks. So once you've opened that account, the next question is, now how do you know which stocks are Sharia compliant? One of the easiest ways is to just look at the prospectus of a Sharia compliant fund. I would recommend SP funds. They have a Sharia compliant ETF that's basically the S&P 500, but just the Sharia compliant stocks in the S&P 500. So if you take a look at sp-funds.com, you can go to their stock ETF and get a list of all the stocks that are in that ETF. And there's your list of Sharia compliant stocks. So that's going to include a lot of the biggest companies in the market. So if you want to do this on your own, this is probably the easiest way. Another easy way is to just buy Sharia compliant ETFs. Again, if you look at SP funds, you'll have a couple of Sharia compliant ETFs to choose from there. You could just buy those, and that's one way to do it. But it's actually not too difficult to get started this way. Now, a lot of people don't have time to do this kind of research or um, uh, set up these accounts and worry about what's happening in the markets or do any kind of analysis. So a lot of people want to rely on, want a little bit of help. So that's where ShariaPortfolio comes in, or other financial advisors that are out there. In our case, at ShariaPortfolio, we actually have two service levels. We've got an express service and we've got an access service. So our express service is our economical solution to halal investing. It's very easy to set up and get started. Our minimum is only $1,000. Our fees are very low. It's only 0.5%. And with these kind of accounts, you can kind of get up and running pretty quickly. You have a professional licensed portfolio manager who will kind of get you set up and review your portfolio with you every year. Now, because it is our economical solution, it is going to be focused on ETFs. So we won't have anything too fancy in here, but it is a good way to get up and running quickly. Our access level service is a more comprehensive wealth management service. So this is kind of a higher level service where you have a personal financial advisor who is going to put you in a portfolio with individual stocks and some ETFs as well. The portfolios are customized to your financial goals. And it's a great, higher level of service. So typically we recommend people who have 100,000 and up, will be well served in the access level service, but both are great solutions for anyone who's looking for a financial advisor or some help in getting started. One of the questions we sometimes get is, how do I choose an advisor? How do I know you guys are the ones I want to work with? So here's a little bit of help. There are three things we think you need to consider when choosing an advisor. The first thing is the investment philosophy. Another way to think of this is, what are these people going to do with my money? Now, I just talked to you a little bit about value investing, and that's what we do at ShariaPortfolio. So you have an idea of what the way we invest. If you're talking to other financial advisors, find out, how they look at the markets and what their investment philosophy is. Do they believe in value investing? Do they believe in technical analysis, or do they have some other approach? You have to find the approach that you're the most comfortable with. So you need to talk to advisors who make you feel comfortable about their approach, and you have to understand that approach. So make sure you understand people's investment philosophy. The other thing is management fees. Another way to look at that is, what is this going to cost me? So make sure you understand this, because a lot of advisors sell products. And what happens is you pay the advisor a management fee for consulting, essentially, and then they also get paid by other sources like mutual funds or insurance products or whatever it is. It's important to understand how your advisor gets paid. In our case, we're fee-only advisors, so we make between 0.5% and 2%, depending on what we're doing for you. So if you want more details on how our management fee structure works, talk to one of our advisors or portfolio managers, and they'll be happy to explain that further. If you're talking to other advisors, just make sure you understand what you're going to be paying. And then the third component is the Sharia compliance. One of the things we've seen a lot is advisors that say they're Sharia compliant, but what they really do is they just throw in a Sharia compliant mutual fund here and there, and then they still invest in all kinds of things that aren't necessarily Sharia compliant. So you kind of want to just do your homework and your due diligence and make sure that your advisor really does understand Sharia compliance. If they have the backing of a Sharia auditor or IOFI or someone, then that can give you an extra level of comfort. But these are the three things that we really think you'll want to consider when you're looking for an advisor. Now, I recommend ShariaPortfolio Canada. Our firm has offices in Ontario and in BC. So we're in Vancouver. Our office in Ontario is in Oakville, near Mississauga. Our website is shariaportfolio.ca, so check us out. And I mentioned earlier that we have our portfolio manager with us, Nadeem. I'd like to invite him to come on right now and have him answer some questions.
Assalamualaikum.
Alaikum salam.
Yeah. All right. So we've been getting some good questions here. I'll start with something that's, I guess, has been asked a few times is, can you share the average return on investment since we started? Now, first off, although we've been in the US since 2003, those those returns are strictly from the US portfolio that we've had. For Canada, we only got started in basically January. So the only thing that we can kind of comment on that is the fact that those numbers, unfortunately, we don't have a long term, but the U.S. portfolios, that's something that does have a longer term track record that we'd be maybe we can take a look at that. The other one, here's another question here about IOFI allows 30% debt, which makes us, which basically they're asking us to explain that. Maybe Naushad, you want to take that question on that?
Yeah, I think, one of the things I like to emphasize is that we don't make the rules. So we follow IOFI guidelines, and I'm not going to question the scholars. They do have a lot of homework that they do on this, and I don't think they take it lightly. Their view on this debt is that these are not Muslim-owned companies. So essentially, if you're Muslim, this is not a mandate saying that you can go out and take an interest-based loan for 30% of your assets. This is simply a ruling that we're investing in companies that are owned by non-Muslims and that we don't have control over. And therefore, because we don't have control, we are allowed up to this 30% threshold. And this is actually a much bigger screen than it may sound. It really does limit how many companies we can invest in. I think there's about 10,000 or so stocks on the US market. And because of this limitation, we actually only have about 2,000 or so that we can actually invest in. So it is a limiting factor. But at the end of the day, we're following IOFI guidelines.
Yeah. All right, and the other question that I have, there's a couple of questions basically on fiduciary and fees. So I think I can answer that. First of all, yeah, we are fiduciary. We're fee-based only. We don't make our money on commission, so this is not a per transaction. And as far as the pricing of it goes, we do have a tiered pricing grid. That all kind of depends on the value, what your portfolio is consisting of. Is it ETFs? Is it individual stocks? Things of that sort. That's something that we would be more than happy to discuss. But what we found is that we're pretty much in the marketplace. Like if we take a look at our competitors, we're pretty much in line with that. There's another question here about Chinese stocks. Do we invest in Chinese stocks? In the past, we have. I think we've in the past we've owned some Chinese ADRs that were listed. Obviously, they were Sharia compliant, and at the same time, we at that time saw an opportunity in them. So we can invest in Chinese stocks. I think as of right now, in the Canadian models, we don't have any, but we might have one or two names in the US model. And can we invest here? So there's a question here. Are there Canadian Sharia ETFs that you can use in your Express portfolios? So I guess the question is more directed towards the SPUS and the SPSK. These are ETFs that are listed on the NYSE. As of right now, we don't have Canadian listed ETFs, but those ETFs can be and are purchased by Canadian investors. And the other thing that I'll kind of add to that is when you're looking at building a Sharia compliant portfolio that's properly diversified, by almost default, you will at the end of the day own mostly investments and securities outside of Canada. That's just kind of how it is. The Canadian market, in terms of the Canadian stock market, It's not as, it doesn't have the depth of other global markets, specifically the US. So, although again, we don't have that Canadian listed ETF, but rest assured, we think that the ETF that we provide is a diversified ETF. There's another question here. Do you have to be in Ontario to invest? I mean, currently we're registered in Ontario and British Columbia, and we are, Naushad, right? We're looking at plans at extending that to other provinces, inshallah.
Yes.
And
Yes.
at the same time, we also do have actually non-resident Canadian clients, except for the US in Canada. So, so there's that. I have another question here. How do you think the real estate market after coronavirus will look like, I guess? So this is a market-related question that maybe, if you're kind of maybe picking our brain, trying to get an idea as far as, who we are and what our think process is. We've obviously seen the volatility in the market in the past 4 weeks. One thing about the stock market you have to understand is that, it's something that we can value on a second-to-second, minute-to-minute basis. And the market does react almost instantaneously as events are folding. However, with real estate tends to be somewhat of a laggard, meaning to say the market is always forward-looking. Prices in real estate tend to lag. So all the economic impact that we're starting to see, the job losses, this and that, eventually it will hit real estate. I think that's what we think, and it's just going to, because at the end of the day, real estate can operate in its own bubble. It's an asset class, just like stocks, just like other investments out there. There's another question here. Is there any reason you prefer ETFs to mutual funds? I think that's also a pretty good question.
Yeah.
I think, I've been in the industry for quite a long time now, and a lot has changed. ETFs, the positives on ETFs are the fact that they tend to be, the costs are lower, they're more transparent, and they're very liquid. Whereas with mutual funds, what tends to happen is the MERs are substantially higher than the ETFs are. And you do get an idea what the top 10 holdings are on a given quarter, but it's not something that can be actively looked at on a daily basis. And of course, liquidity. Markets, as we see, have been really volatile. With mutual funds, you're always selling it at the end of the day, and you're not really sure what you're going to get. I mean, you basically get the value at the end of the day. So sometimes, you'd rather sell at different times of the day. So I think it's really threefold: it's transparency, it's liquidity, and it's cost. I'm just gonna scroll here. There's a lot of questions, and I'm just looking, and I'd love to answer them all, but I'm going to go for some of the more interesting ones. Okay, so again, I have a question here. Would a company like Apple be classified as a halal company to invest in? What about supermarkets, given that they sell alcohol and tobacco? So I think Naushad touched on that a little bit with his Delta example. Our standard that we follow, the IOFI standard, allows the non-permissible income is a 5% threshold. So as long as the supermarket doesn't exceed that, then you're okay. And I guess the perfect example in this case is actually Walmart, believe it or not. Walmart on surface looks like it's a halal business. However, at one time, and I think even still currently, Walmart is actually the largest seller of weapons in the US. And so just on that metric alone, it probably failed, and it's still failing right now. So, to answer that question, that's probably it. However, we haven't taken a look at some of the Canadian supermarkets like a Loblaws, which I'm pretty sure we don't sell guns. So from that standpoint, it might actually pass. Okay. So there's let me show you performance in the past 15 years. Again, a lot of questions about our performance, in the US for the past 15 years. And, they like to compare it to the S&P return. Again, we in the U.S. and in Canada, this is just more of an education purpose. Like we have 4 different models, and so our models are tailored to the investor. We don't have, it's not a one-stop shop. In other words, we have a conservative model, we have a balanced model, a growth, and a stock only, which I guess is our most aggressive model. So when I'm getting questions about performances, it does depend on what we're talking about here. It's not exactly a one number that I can pop out. Obviously, we deal with every client from every spectrum. So whether you're in retirement, entering retirement, or whether you're new and you're looking to grow your capital and you're more of the aggressive nature. So as far as that goes, I would say, I'd leave it to that. But compared to the S&P, I would, what I can say is from a Sharia Portfolio Canada point of view, we, and even, our company in the US, these past 3 months, we've actually been outperforming the S&P quite substantially. And if that's not, good enough for you, then I would basically suggest pull up the SPUS, the ETF, that's our ETF, and pull up the SPY, which is basically the S&P 500 ETF. And even though our MERs are naturally going to be higher, we're actually significantly outperforming the S&P on our ETF alone. So, I think, alhamdulillah, I think in the most important times, in the most volatile times of the market, we've been outperforming the S&P 500. And I think that's the true testament of a real portfolio manager when markets go through these periods of volatility. Now, when the markets are going higher, you know what, every Tom, Dick, and Harry out there is making money, and that's good. But I think when you enter into these volatile periods, that's when you get the true testament of a portfolio manager. What's the biggest difference between your US portfolio strategy for US clients versus those in Canada? So that's a good question. I think, first of all, I would like to say the Canadian models were, in some cases, you can say, born out of the US, in the sense that myself being the portfolio manager, I was brought onto the team last year after, spending many years at other financial institutions in Canada. And when I got kind of brought into the ShariaPortfolio family, the Canadian portfolios, I guess you could say, were born from the US. In other words, there is a lot of consistency between the two in terms of some of our top holdings. So, for example, we own Johnson & Johnson in the US model. We also own Johnson & Johnson in the Canadian models, Microsoft. But there are some differences, and the differences really are that in the Canadian models, when it comes to our equity positions, we do have a Canadian component there. So we do own some Canadian stocks in the Canadian models, and the allocation for the stocks is roughly about 15, maybe 20%. So ultimately, it's still heavily weighted in outside of Canada. And again, we do that for diversification purposes, for the simple reason that if we are, say, bullish on healthcare, or we're bullish on biotechs or health pharmaceutical stocks, there's not many Canadian options out there. And likewise, when it comes to technology, if we're bullish on that sector, the pool in Canada tends to be very limited. So though there are a lot of similarities, but there are some differences on that. And also in the US, my colleague in the US is we sit on the same portfolio management team, but my colleague in the US runs the US models, whereas I run the Canadian models. When is a good time to sell stock or mutual fund? That's I think that we answer that question every day, right, Nishad?
Yeah, we do.
Yeah. Well, I don't think there's a perfect answer for that. I just thought it was an interesting one out there that I decided to think. But typically what ends up happening is, when we take a look at, say, for example, any given company, any stock, we kind of do our homework. We do the fundamental analysis and some of the other analysis that goes into it. And ultimately, yes, we do come up with some type of an idea as far as what we think our target is for that stock. Now, ultimately, in a perfect world, when it reaches that target, then you know what, there comes a decision point where we decide, okay, it's restart target. What do we do? Do we sell all of it, part of it? I mean, it really kind of goes on a case by case basis. But to give you some idea, we do kind of draw a soft line in the sand to say, okay, it's restart target. What do we do at this point? And likewise, on the flip side, is if we're not going to get all our calls right, when we do make some mistakes, we realize we take a look at and we figure out, okay, is this still worth holding? Is the value still there, or has something really fundamentally happened to the company or the sector or whatever that you know, causes us to sell the stock? Okay. So I have another, this is a good one here actually. I'm not sure I understand the significance of ETFs and why they are preferred over stocks. So as you know, for our Access service, for our you know, Access portfolios, we actually use a core satellite approach. And what that really is, it's a combination of the two. And where we use ETFs for that passive component, and that passive component provides something. It gives you access to a diversified pool of stocks or bonds or sukuks in our case, and you know, it gives you that access, you know, at a relatively cheap cost. So for example, like the RSPUS, it allows us to buy close to about 230 stocks, and with the SPSK, I mean, there's about 75 Sukuk bonds in there, and otherwise you can't. I mean, it's very difficult to go out and buy a Sukuk bond yourself. So that's why, you know, those are some of the positive behind an ETF. And what we then do is that kind of becomes the core, and then the satellites are the individual stock holdings that we think that you know, can provide that extra return. So the ETFs ultimately, they're kind of keeping in line with the market. And subsequently the you know, the individual stocks are where we think we can create alpha, take advantage of some opportunities. If we feel we need to be overweight or underweight certain sectors of stocks, it gives us that flexibility to do so. Are you holding any Canadian equities in the Express portfolio since there are no Canadian Sharia compliant ETFs? I guess, you know, that's the quick answer to that is probably no, in the sense that our SPUS, the ETF, you know, what we basically did was we took the S&P 500, the 500 stocks that are on the S&P, and so those 500 stocks are all US, and ultimately what we did is we IO feed it, I guess. We applied our IO feed screen onto it, and out of that 500, we got left with about 230 names or so. And so ultimately, yeah, those are predominantly US, those are all US companies. And the Sukuk ETF, which is the fixed income, that's also not invested in Canada. So yeah, so the quick answer to that is no. However, in our Access portfolios, we do have Canadian holdings in there. Okay, how serious is the impact of coronavirus on the market? How long do you think it will take for the market to rebound? Okay, that's a good question. So obviously, it's been this has been an eventful 4 weeks or so, however long it's kind of impacted our life, and it's had a strong impact on it's had a strong impact on global markets. So, you know, our view is, you know, we saw a lot of fear come into the market. We saw a correction in the market like we've never seen before. In my estimation, I think it was as bad, if not worse, than 2008. And what we've learned is that, number one, is what's your time horizon. If your time horizon is not the next 6 weeks or 6 months, and it's longer than that, then, you know, this was and still is a good time to be building that capital. How long do we think? We think that you know, a lot of factors are moving, but we do think that, you know, it's going to be anywhere from a U type of recovery, in the sense that you know, in the past we've seen the market kind of digest this downturn, but ultimately we think there are going to be opportunities in the market, and really what you need to do is have an investment strategy in place that can thrive on the current market, survive in the current market, and at the same time thrive in the post-corona market. I've been told that we've been running out of time, so I'm told to be wrapping it up. I would have loved to answer so many more questions. I think I have 56, and I probably only got 2. I don't know, maybe 6 or 7. But I'll tell you what. If you have more questions, feel free to email us. I think our contact information is out there. You can reach out to the central line or myself, and inshallah, would be happy to try to pick up where we left off today.
And feel free to contact either of us directly. You can reach me at noshad@shariaportfolio.ca, or you can reach Nadim at nadim@shariaportfolio.ca, or feel free to call us. Our phone number is on the screen right now, 604-260-7150. Thank you all for attending the webinar today. I hope we were able to offer some value in our presentation, and thank you, Nadim, for answering all of those questions. Please stay safe out there with the current conditions as they are. Don't take any unnecessary chances. And we wish you and your family safety during this period. And also Ramadan Kareem.
Yeah, Ramadan Mubarak, guys.
All right. Assalamu alaikum.
Welcome.